What's up, guys? I hope you're doing well. James again from jamesdforsythe.com. Pretty much wanted to really talk and kind of synthesize my thoughts about some of the stuff that I've been reading and kind of tying it into this past week's videos for central bank digital currency, right? But more of just like kind of the types and kind of the definition of money in general, right? And I'm working out of town, which is why the truck and a wired mic to hopefully, because I know phone microphones could suck. So we're gonna give that a shot. But anyways, um, so I mean, you hear people like Robert Kiyosaki talk about it a lot. The whole like debt is money, right? And one of the things that I noticed I repeated a lot last week was the whole like all of money, right, is a liability of somebody's, right? It's a debt, right? And so like your bank deposits are a liability of your commercial bank. Cash is a liability of the Federal Reserve. The definition of a central bank digital currency would be a liability of this of a central bank. In our case, in America, the Federal Reserve, right? Um, but one of the interesting things, because that got me thinking, the whole like it's a liability of someone's, so it's debt, really. And so, and this kind of really set off a light bulb when I was reading this book that I just got called Central Banking 101 by Joseph Wang. Trying to get it to where you can see the fucking maybe. There we go. Um, so you can see that. And so basically, um, he was talking about like even like treasuries, right? They're a debt of the federal government, right? And so, and those in the banking system are used as collateral for one, for like example, like money markets are used as like pristine collateral or whatever in in repo markets. Um, and then also he brings up stuff like mortgage-backed securities, which is why that second part in the title, maybe even your mortgage, because a lot of the times, there's a big change, if I remember correctly, um, in kind of the business models for mortgages and commercial banks. Like commercial banks used to basically they would lend mortgages and stuff or create mortgages and then basically hold them to get interest. Well, now it's more of they basically originate the loans and then sell them off to some form of securitization firm, or I'm not 100% sure on the technicalities on that. But basically, the whole they'd package up the mortgages into securities and sell them off to investors, right? Um, and then those would be used. That's another form of debt. It's your mortgage, right? And so those would be used similarly to as treasuries are for like the repo market. The mortgage-backed securities would be used as kind of the same form in. They used to also be in the repo market, but I don't believe they are to the same extent. Um, I think they used to be more in was the unsecured funding markets. Now, there's a lot of different markets that I've noticed. And this is a book that I highly recommend, and that I mean, I'm gonna have to read this multiple times because he does a really good job of really synthesizing information. I mean, it doesn't go very in depth with things, but it's called Central Banking 101 for a reason. And it kind of just like goes right over the basics of everything, I guess. And so like the little intricacies and like how things are related. Um like currency swaps or and stuff like that, to where I was never really sure of it. Like there's some things to where I was like, I'm not sure where this what that is, and I'm not really haven't spent enough time to like look fully in depth in that specific topic for whatever reason. Then it's like one or two sentences to where that light bulb goes off. It's like, oh, that makes sense. Um, so yeah, basically, and then he also goes into like one of the reasons or one of the things that I've been looking into more is like the euro dollar system and shadow banking and stuff like that, because I was like, I don't really get what that means. And then he goes in depth in that to some extent, but not to get too far from the topic or from the topic of the video, right? So the whole form of like how debt is used as money in some form, and so like those mortgage-backed securities per se would be used as kind of the foundation to produce more loans and so on. And so it's kind of like a pyramiding effect, it seems. Um, anyways, I just kind of wanted to show that a little bit, or like kind of, I guess, propose it in a way, because that's something, obviously I haven't synthesized it completely. Um, and also just kind of open it for discussion, I guess, because I can see where like the treasuries would work. Because he talks about how like you have the different entities that can quote unquote print money, right? And so you have, everyone knows like commercial banks, or I hope knows the commercial banks, and then there's the Federal Reserve, when they create their own liabilities, right? And then there's also the federal government, which kind of in the same way is doing the same thing when the Treasury issues treasuries, right? They're issuing debt. So it's a liability of the Treasury, and they have to pay back that somehow. They just happen to pay that back denominated in Federal Reserve liabilities, dollars. Because I guess like, no, if it was cash as well, either way it would be in some form or fashion. It seems that everything is at least settled in central bank liabilities, right? Because it's either you have, if those treasuries go to bank entities, like commercial banks or other uh, financial institutions that can hold bank reserves, then those debts, in this case treasuries, are kind of paid back or and dealt with in bank reserves, which is a central bank liability that only like those institutions can hold. But if like say a individual or a business that is not eligible to hold bank reserves has those treasuries, then on their end they see the commercial bank liabilities, their bank deposits. But on the back end, whenever those commercial bank um, liabilities are transferred or anything, when they're transferred from, let me do this better. So when the treasury pays that individual, right, that individual gets bank deposits, right? Or they can get physical cash, I guess. But I think it would come back as bank deposits first, right? And so that is a commercial bank liability. And then on the back end, though, when the Treasury is doing that, what they're doing is they're transferring bank reserves from the TGA, the Treasury General account, to that individual's commercial bank, um, as bank reserves, right? And so either way, that transaction is initiated or settled, or however you want to talk about it, in central bank liabilities, which are bank reserves in this case. And if somehow they paid, I don't know if the Treasury will just send cash to people. Um, I don't know. I don't think so. All I know is when I uh sold or what redeemed whenever I redeemed my savings bonds from when I was a kid, that was a huge thing, or was a thing in my family. It's like every birthday you got like a $50 savings bond or something. And so whenever I redeemed those, I basically I had the paper ones because they were from before they transferred everything digital. And then like I had to send those to the Treasury Direct office, I think in like Minneapolis or something. I don't know. I don't remember. Um, and then they did everything electronically, so I don't know if they'll send you cash. Um, I don't think they would. It'd just be some form of deposit, and then you could, I mean, go to your commercial bank and like withdraw cash, but that's different. Anyways, um, I don't know. Just kind of want to get that thought out there and kind of think about it a little more out loud. So hopefully that helps you guys a bit. But anyways, I'm gonna leave it at that. I need to get going. So anyways, I hope you guys have a good day, and I'll see you on the next one.